Hi guys, today I'm in the most sanctioned country in the world, but it's another topic. If you may be interested, let me know. Today we walk through leveraged ETFs, those 2x and 3x funds that promise to supercharge every bump and bruise in the market. Most YouTube shorts reduce them to a single warning: decay will kill you. But a fresh 2025 study by Chung-Han Hsieh and colleagues shows the real story is more like a weather forecast. Occasionally sunny, sometimes stormy, and always changing. We will translate that paper into plain English and real-life examples and end with the checklist you can pin above your desk. First of all, why people fear decay and what it actually is. Imagine you buy an S&P 500 index at 100. Day 1, it rises 10% to 110. Day 2, it falls 10% to 99. Net change, -1. That tiny gap is volatility drag. Now, bolt on 3x leverage. Day 1, you rocket 30% to 130. Day 2, you plunge 30% to 91. Gap, -9. Same pattern, bigger bruise. Because leveraged ETFs reset their exposure every afternoon. They relieve that bruise over and over. That's why Decay headlines get clicks. The concept is real, but it is only half of the movie. Second, the missing half, market mood trumps math. Hsieh's team argues that how prices move matters more than how much they wiggle. If markets march in one direction for weeks, think 2009, 2013, or the AI boom of 2023. Leverage can tack on extra return because each day's new base is higher than yesterday's. If markets behave like a SSO 2014-15 or spring 2022, leverage amplifies the back and forth and leaves you tired, not richer. Their big quote, return dynamics, not volatility alone, determine whether leverage ETFs beat or lag. Real-world proof, the gentle bull and the grumpy range. The study built perfect leveraged portfolios, no fees, perfect feels, then compared them with live funds like SSO, 2x S&P and SPXL, 3x S&P. During the 2009-13 uptrend, perfect 3x S&P portfolio ended the period almost 2 percentage points ahead of simple triple SPXL. Even after fees and spread costs still beat its mechanical target. In the sideways 2013-15 tape, the tables flipped. Both perfect and real funds undershot their triples, with SPXL lagging by nearly 2% a year. Same toolkit, two different weather patterns, two opposite outcomes. For bear funds, why they disappoint in panics? Leveraged inverse ETFs feel like obvious crash insurance, but 2020 showed their weakness. When COVID headlines hit, markets plunged, then bounced almost as fast. The inverse FRIX fund closed up sharply, hesitated for a day or two, and then gave back its gain as prices flipped. So, the fund's daily reset meant it closed higher on fresh down moves, but never kept the earlier wins. So, the final tally looked mediocre. Hsieh's data pairs each bear fund's result with a chart of daily autocorrelation. When that number dives negative, lots of snapbacks, inverse leverage suffers. Rebalancing speed, a gear shift your control. Daily reset is baked into ETF rules, but no one forces you to top up your personal positions every night. The authors simulated weekly and monthly levers. In a cleanup trend, daily was king, capturing each leg higher, locked in gains. In choppy months, slower levering cut drawdowns roughly in half. Practical takeaway: if you manage your own leveraged basket, say by combining SPY futures and T-bills, consider stretching rebalance intervals whenever your trend indicators flash yellow. 5 quick investor profiles and what leverage means for each. The day trader lives and dies by morning momentum and use catalysts. For them, daily leverage ETFs are tools, not investments. Decay is irrelevant Bids and asks are everything. The swing trader holds 1 to 6 weeks. Leverage can boost returns if a confirmed trend is in play. They track the 50 days moving average and weekly RSI. When those flatten, they degear. The DIY hedge fund trades sector views over months. This crowd uses index futures more than ETFs because futures let them adjust leverage smoothly and avoid fund fees. Hsieh's study suggests they shorten rebalance windows only in strong momentum phases. Sorry if I pronounced his surname wrong. The passive investors dabbling in SPIs buys TQQQ for fun. For them, leveraged is usually a bad fit. They underestimate the emotional tax of minus 12% days. Better, keep SPIs tiny, set a stop loss, and revisit monthly. The risk manager oversees a portfolio of vanilla ETFs and wants a fast hedge during Fed shocks. Short-term inverse funds can work, but they must be refreshed every few days, or the hedge drifts. Knowing which bucket you belong to is step one. Mislabel yourself and leverage becomes an accidental hand grenade. That truth never changed, no matter what paper you read. 7. Cost reality, the invisible gravity. The study's tables show that real 3x funds underperformed their perfect cousins by roughly half a percentage point a month in quiet periods and more in frantic ones. Why? Higher management fees, wider bid-ask spreads, and occasional tracking slippage. These silent costs scale with leverage and with how often you trade. So a rule of thumb, treat all quoted expenses ratios as minimum drag. Your true cost of ownership after spreads and slippage will be higher, sometimes double in volatile weeks. Factor that into any back-of-the-envelope forecasts. The advanced decline split. If 5 out of the past 6 weeks saw more advancing S&P stocks than decliners, you're likely in trend. Leverage leans friendly. Second, the 13-day average true range as a percent of price. Above 6% often signals chop. Below 4% hints at trending calm. Higher ATR doesn't always destroy returns, but it raises whiplash odds. Third, new high, new low list. When fresh highs outpace fresh lows by 2 to 1, trends often stick. Leveraged bulls, like that math, leveraged bears want. These aren't crystal balls, just traffic lights. Combine 2 green lights and leverage might earn its skip. 2 red lights either scale down or shorten holding periods. A 30-day challenge plan. Suppose you believe tech earnings will drive the Nasdaq higher over the next month. Here's a plain English game plan using a 3x fund such as TQQQ. First of all, allocate only the dollars you'd normally put in a 1x view. Say 3% of your portfolio and let the fund give you the extra punch. Second, set a mental exit if the Nasdaq closes under its 20-day moving average. It means momentum is cooling. Third, review trend goals every Friday. If 2 or more flip to chop, switch from TQQQ or a plain QQQ or just cash. 4. Commit to closing the position at the 30-day mark no matter what. Leverage overstays rarely and well. You might hit the target, you might not, but you have a process that lines up with the research. Write trends briefly, respect the calendar, shrink size. And key quotes worth memorizing from this brilliant research. Return dynamics, not volatility alone, determine whether leveraged ETFs beat or lag. Trends enhance returns, mean reversion induces underperformance. Daily rebalancing is best momentum market. Slower rebalancing reduces pain in choppy ones. Print them, pin them, share them. These 3 lines summarize 20 pages of equations. And a simple 6-point checklist here. First of all, identify the market mood before you touch leverage. Rising moving average, green, whipsaws, red. Choose the right gear. Daily reset for fast trends, slower reset for smaller sizes for ranges. Mind the calendar. Leverage is a sprint, not a marathon. Set an end date when you open the trade. 4. Keep sizes small. A FX ETF can drop 30% in a week. Make sure that won't wreck your plan. 5th, account for hidden costs. Budget extra basis points for spreads and trading. 6. Review often. Exit quickly. When the mood changes, leverage won't forgive delay. So guys, follow these 6 and you've already moved from casino odds to disciplined speculation. Final takeaways here. Leverage ETFs are magnifiers. Point them at a clear, calm trend and they enlarge your gains. Point them at a jittery market and they enlarge every wobble. Decay isn't a permanent curse. It's a byproduct of chop. Use leverage as a short-term tool. Size it modestly, track the market temperature, and refresh your seatbelt settings often. Do that, and the same products that spook many advisors can become precise, powerful instruments in your kit. For sure, it's not personal investing advices. Thanks for staying to the end, despite on the falling camera of this longer, more detailed tour. If it helped you see leverage in a new light, tap subscribe, share it with a friend who still thinks Decay is the only story, and let's keep learning together. Until next time, stay curious, trade responsibly, and may your risk always match your goals, guys.